Welcome to a special Talk Tickers edition of the Deep Dive. We are so glad you could join us today. You look at a traditional manufacturing company, and their financial health is usually just this masterclass in precision.
Oh, absolutely. It's very binary.
Right, exactly. You put $1 of raw materials to a machine, you get a physical widget out on the conveyor belt, you count the widgets, and the math is just incredibly clean.
Yeah, it's comforting.
It is. But then you step into the world of tech platforms, right? Digital marketplaces, the modern attention economy, and that simple, comforting equation just disintegrates completely.
It really does. It becomes this landscape of, well, diagnostic muddy waters, because we inherently want businesses to be visible, easily categorized into neat little boxes.
They just aren't.
No, because a digital marketplace operates on a totally different physical reality. You're dealing with gross merchandise value versus actual realized revenue.
Yeah.
And these massive chasms between adjusted operational earnings and what is actually sitting in the company's bank account at the end of a given quarter.
Which is exactly why we are ripping into the first quarter 2026 earnings call transcript for StubHub today. Ticker symbol STUB.
It's a fascinating one.
It really is. And the mandate here for Talk Tickers is simple, right? We are data forward, we are aggressively opinionated, and we are relentlessly focused on finding the signal through all the corporate noise.
Yeah, translating that Wall Street jargon into something you can actually use.
Exactly. We are tearing down that jargon to figure out if this newly public iteration of the company is a viable, long-term portfolio play or, just a house of cards leaning on post-IPO hype.
Yeah.
So, okay, let's unpack this.
Where do we start?
Well, before we even touch the dizzying Q1 numbers, we have to contextualize the battleground. The live events industry is not your normal consumer discretionary sector.
No, it's really not. I mean, if you look at the historical data over the last quarter century, the live events sector, so concerts, theater, professional sports, it has demonstrated this structural resilience to macroeconomic headwinds that frankly defies traditional consumer logic.
Yeah, it doesn't make sense on paper.
Right. We are looking at an industry that absorbed the immediate psychological shock of 9/11, powered straight through the great financial crisis in 2008, and navigated the intense, margin-crushing inflationary pressures of 2022 and 2023 without missing a beat.
Wow.
Outside of the global pandemic, artificially and legally mandating the shutdown of physical gatherings, the aggregate demand curve for live events just trends upward.
It violates everything you learn in Econ 101.
Completely.
You would inherently assume that a ticket to see, the Green Bay Packers or some massive stadium pop tour is the ultimate discretionary expense.
The first thing to go.
Right. It should be the very first line item slashed from your household budget when gas prices spike or mortgage rates double. But those 26 years of historical data that StubHub's management cited in this call, they paint a totally different behavioral reality.
Yeah, the CEO articulated a theory of consumer behavior on the call that essentially states human passion defies basic economic gravity.
I love that phrasing.
It's accurate, right? The psychological driver here is identity. Attending these events is deeply tethered to a consumer sense of community, their tribal affiliations, and just their baseline joy.
Yeah.
In the mind of the fan, a live event ticket behaves much closer to a household staple than a luxury good.
Wait, really? A staple?
Well, think about it. If a diehard fans team makes the playoffs, they are going to that game. They will cut back on dining out, they will delay buying a new television, but they will fund that ticket.
It is the ultimate stress test of the modern consumer's wallet, and they are passing it by continuing to swipe their cards.
Exactly.
So that structural resilience sets the perfect stage for the Q1 2026 print. The headline numbers here are aggressive, but they require serious translation because, they're telling two separate stories.
Yeah, let's start at the very top of the funnel with gross merchandise sales, or GMS.
Okay.
This represents the total aggregate dollar value of every single ticket sold across both the StubHub and Viagogo platforms globally. For Q1, GMS hit $2.2 billion. Yeah, that is a 7% increase year over year.
$2.2 billion of liquidity moving through the plumbing in just 90 days.
Huge volume.
But here is the critical trap for anyone evaluating a marketplace stock, right? Whether it's Uber, Airbnb, or StubHub. GMS is not revenue.
No, GMS is strictly the volume of trade. What's fascinating here is the delta between that total volume and the capital StubHub actually captures.
Right.
Their reported revenue for the quarter was $446 million, but the growth rate is where the real signal lies. Revenue jumped 12% year over year.
Okay, so revenue is growing nearly twice as fast as the underlying sales volume.
Exactly.
I mean, StubHub operates exactly like a massive, sprawling casino.
Oh, that's a good way to look at it.
Right. The gross merchandise sales, that $2.2 billion, that is all the money moving around on the tables. It's the chips sliding back and forth between the buyers and the sellers, the poker players betting against each other.
And the casino doesn't own those chips.
Exactly. But the revenue, that $446 million, that is the house edge. That is the rake the casino takes off every single hand played. These numbers show the house edge is getting sharper.
Yeah.
They are extracting significantly more yield off a relatively similar amount of betting volume.
And the underlying mechanic driving that is their take rate, or their conversion rate. Management highlighted that this rate is normalizing back toward a historical baseline of roughly 20% for the full year.
So they take 20 cents of every dollar on the platform.
Pretty much. But to understand why it's growing now, we have to look back at 2025. Last year, they deliberately suppressed their take rate.
Oh, interesting.
Yeah, they were essentially subsidizing transactions, taking a smaller cut of the pie to aggressively capture market share and choke out secondary competitors.
Buy the loyalty now, tax it later.
Precisely. Now that they have entrenched that market leadership position, they are turning the dials back up. They are proving they possess the pricing power to extract that 20% yield without causing demand destruction.
They bought the loyalty of the market, and now they are monetizing it. And you can see that pricing power bleeding directly into their adjusted EBITDA.
Oh, for sure.
They posted $72.1 million in adjusted EBITDA for the quarter, reflecting a 16% margin. And the transcript highlights a 400 basis point expansion year over year.
I mean, a 400 basis point margin expansion in a 12-month window for a mature tech platform is immense.
It's massive.
To compound that, their gross margin expanded by 100 basis points to reach 85%.
85%.
Yeah. Operating at an 85% gross margin firmly places them in the upper echelon of pure software economics. They are essentially moving digital barcodes, so the marginal cost of inventory distribution is effectively zero.
Okay, but here's where I want to rip into the income statement. Because reading these top-line metrics in a vacuum is incredibly dangerous.
Very true.
You have $2.2 billion in GMS, $446 million in revenue, 85% gross margins, and a 400 basis point expansion in EBITDA. Those are hyper-growth tech darling numbers.
They look pristine.
But then you scroll down to the actual GAAP net income. The raw, unadjusted bottom line sitting on the SEC filing is $4.2 million.
Yeah, it's a big drop.
If the gross margin is 85% on nearly $500 million in revenue, a $4.2 million net income looks fundamentally broken. Where is the rest of the cash going?
It looks like a glaring red flag if you are solely relying on a stock screener. This is why tearing through the transcript is non-negotiable.
Right.
You have to build the bridge between that $72.1 million adjusted EBITDA and the $4.2 million GAAP net income. There are three specific heavy line items dragging down that raw bottom line this quarter, and evaluating them is the only way to gauge the actual health of the core business.
So walk us through the bridge. Where exactly is the cash leaking?
Well, the heaviest anchor is stock-based compensation. StubHub is navigating its immediate post-IPO phase.
Right, everyone wants to get paid.
Exactly. Retaining elite engineering and executive talent requires aggressive issuance of restricted stock units, or RSUs. The CFO specifically flagged elevated general and administrative expenses driven by the front-loading of payroll taxes associated with this stock-based comp.
Okay, so it's an accounting reality, but it's largely a non-cash expense. It hits the income statement and crushes GAAP profit, but it isn't actively draining liquidity from the corporate treasury.
Correct.
We'll get to the dilution impact of those RSUs later because it's a silent tax on the shareholder. But what are the other two anchors dragging this down?
The second is the interest expense tied to their legacy debt structure. They emerged from a highly leveraged private equity buyout and a subsequent pandemic-era restructuring with a significant debt load.
Yeah, floating rate debt in this environment is rough.
It is. Servicing the interest on that floating rate debt is a very real cash drain that hits the net income line directly.
And the third?
The third factor consists of non-recurring professional fees. The lawyers, auditors, investment bankers, all tied to their transition into the public markets. Adjusted EBITDA strips these out to show the operational baseline, which is that $72.1 million profit engine.
So the core machine is highly profitable, but the corporate superstructure is just temporarily weighing it down.
Precisely.
The top line numbers are flashy and the bottom line is artificially depressed. But the actual thesis for holding this stock long term relies entirely on why those profit margins are expanding so aggressively in the middle of the income statement.
Right. And that margin expansion is entirely driven by a phenomenon called operating leverage. The management team was incredibly transparent that 2025 was a brutal investment year.
They spent heavily.
They sacrificed immediate EBITDA to capture market share, boost liquidity on the platform, and refine the user experience. They essentially paid a premium to guarantee that when a consumer thinks of secondary ticketing, they think of StubHub.
Here's where it gets really interesting. They built a massive structural moat. Think of their 2025 capital expenditure strategy, like building a massive multi-lane toll road.
Oh, I like that.
They spent billions laying the concrete, paving the lanes, and building the infrastructure. It was capital intensive, it hurt their margins, and it looked ugly on the balance sheet.
Very ugly.
But now, in 2026, the concrete is dry, the toll road is fully operational, cars are driving through, and StubHub is just sitting in the toll booth collecting a fee. The beauty of this model is that it costs them absolutely nothing extra to let the 1 millionth car through compared to the first car.
Yeah, the marginal cost is flat.
The fixed costs are flat, so every new dollar of revenue drops almost entirely to the bottom line.
You can see that exact dynamic playing out in their sales and marketing line item. S&M dropped to 50% of revenue this quarter.
Wow.
That is a massive 500 basis point improvement year over year. Because they have achieved dominant brand saturation, they no longer have to rely on hyper-expensive paid customer acquisition channels.
They aren't bidding wildly on Google AdWords for every single transaction anymore.
Exactly. The organic brand awareness is doing the heavy lifting. The consumer bypasses the search engine and goes straight to the StubHub app.
And they are taking that stabilized domestic toll road and aggressively exporting it. The international metrics buried in this call are staggering.
Oh, they are. Latin America and the Asia-Pacific regions are currently heavily outpacing their North American growth.
It's the globalization of live events.
Yeah, you have the NFL playing regular season games in London, Germany, and Brazil. You have global pop superstars booking 150-date world tours that touch 5 continents.
And StubHub captures all of it.
Because StubHub operates a unified global back-end architecture, they can seamlessly capture that international demand. They don't have to build a new tech stack for every single country they enter. They just localize the interface and flip the switch.
It's the ultimate scale advantage. But honestly, the international expansion isn't even the most disruptive thing in this transcript.
No, it's not.
The real structural pivot, the mechanism that could fundamentally, permanently alter their valuation multiple, is how they are sourcing the tickets. The CEO spent a significant portion of the call outlining a transition away from a business development-led approach to a product-led self-serve platform.
Yeah, pushing this philosophy of open distribution and direct issuance.
Right.
This is arguably the most critical strategic shift we've seen in the ticketing space in a decade. Historically, the pipeline for getting inventory onto a secondary platform was incredibly clunky.
Very manual.
It required a team of business development executives flying around the country, taking venue owners to steak dinners, negotiating bespoke exclusive contracts. Then the actual technological transfer of those tickets involved manual uploads, spreadsheets, and just high-friction legacy software.
It was an archaic, relationship-driven bottleneck.
Completely. And StubHub is abandoning that model. Instead, they're building direct API integrations into the primary ticketing software that these venues already utilize. The transcript specifically highlighted a new integration with the primary ticketing provider for Stanford University Athletics.
Okay, so mechanically, how does that actually change the game for the box office manager at Stanford?
Well, in the old regime, Stanford might be contractually locked into selling their primary inventory through a single exclusive portal.
Right, like a Ticketmaster or an AXS.
Right. And if a game didn't sell out, they just ate the loss. Now, with this API integration, the Stanford box office manager has a dashboard with a literal toggle switch.
Just a switch.
Just a switch. If it's 48 hours before kickoff and they have 2,000 unsold seats, they don't have to negotiate a new contract or manually export barcodes. They click a button, and that unsold primary inventory is instantly syndicated onto StubHub's global marketplace.
It is exactly the Expedia model. The airline industry figured this out 20 years ago.
Yes, they did.
Delta doesn't demand that you only buy a seat on Delta.com. They understand that an empty seat when the cabin doors close is zero revenue. It's a perished asset.
Yep.
So they push their inventory to Expedia, Kayak, Travelocity. They want their product in front of as many eyeballs as possible.
Yeah.
StubHub is positioning itself as the Expedia of live events.
Exactly. They want to aggregate the fragmented supply of the primary market and match it with their massive global demand engine.
And the technological catalyst driving this open distribution push is a new tool they launched called Distribution Manager.
Yeah, this is key.
It's an AI-powered self-serve platform designed specifically for artists, teams, and venues. It allows rights holders to use natural language prompts to set dynamic pricing floors, identify inventory blocks, and instantly push tickets live.
But the real moat here isn't the AI interface itself, it's what the AI is trained on.
The data.
Exactly. This tool sits on top of 25 years of proprietary StubHub transactional data. It feeds rights holders real-time demand signals and pricing elasticity models before they even hit publish.
Okay, I have to stop you there because the AI narrative in 2026 earnings calls is frankly exhausting.
No, I know.
Every single management team is shoehorning AI into their transcript to algorithmically pop the stock. They also mentioned an integration with Anthropic's Claude to help consumers discover events via a chatbot.
Right.
So tell me, is this actual revenue-generating utility, or is it just corporate buzzword bingo designed to appease institutional tech analysts?
Well, this raises an important question about how we differentiate between structural AI advantages and purely cosmetic features.
Right.
Management was surprisingly candid about the consumer-facing Claude integration. They openly admitted it is not currently driving material financial results. The traditional search and browse functions remain the dominant conversion channels.
So the chatbot is just a shiny object for the press release.
Pretty much. It's a defensive hedge. Management's thesis is that if consumer search behaviors fundamentally shift over the next decade, if people stop using Google and rely entirely on AI agents to plan their travel and entertainment, StubHub must have its hooks deeply embedded in those LLMs.
It's a low-cost option on the future of search.
Exactly. However, the AI architecture powering the distribution manager is a completely different story.
Right, the B2B side.
Yeah, that is not buzzword bingo. That is a direct operational efficiency that drastically lowers the friction for massive enterprise sellers to dump their inventory onto the platform. It creates liquidity. More liquidity drives higher GMS, and higher GMS drives revenue.
Because of that proprietary data.
Exactly. The data advantage they possess, knowing exactly what a Tuesday night baseball ticket in Chicago sold for in 2018 versus 2024, it allows venues to maximize yield in a way they couldn't do on their own.
The moat is deepening on all sides. They have the consumer brand awareness to lower acquisition costs. They are building the frictionless API pipelines for enterprise sellers, and they are leveraging a quarter century of data to optimize pricing.
It's a very solid foundation.
So with that structural foundation established, we have to look forward. How is management projecting this machine will perform for the rest of 2026?
The guidance section of the transcript is where the management team's conservative posture becomes highly apparent. They reiterated their full-year guidance without an upgrade.
Without an upgrade.
Nope. They're projecting GMS between $9.9 billion and $10.1 billion, which implies an 8 to 10% growth rate. Adjusted EBITDA is forecasted to land between $400 million and $420 million.
This is where the narrative disconnects for me. If Q1 was such an absolute blowout, a 12% jump in revenue, a 400 basis point expansion in profit margins, crushing the international growth metrics, why keep the full year guidance flat? Did they just experience an anomalous lucky quarter? Are they looking at internal data suggesting consumer exhaustion or a macro downturn hitting in Q3?
I see why you'd think that, but if you parse the Q&A session with the analysts, there is zero indication of underlying weakness. Analysts pushed them hard on this exact point.
As they should.
They asked about fan exhaustion, consumers trading down to cheaper seats, elevated concert cancellation rates. Both the CEO and CFO flatly rejected those premises. They stated they ran the flash financials just prior to the call, and Q2 is tracking exactly to their aggressive internal models.
Then why not raise the guidance and take the easy stock bump? That's what everyone does.
Because they are trying to establish a reputation of structural predictability. Newly public companies that miss their own raised guidance get slaughtered by the market. Furthermore, The live events business is intensely seasonal. The first half of the year builds momentum, but the second half is a financial juggernaut.
Right, the fall sports calendar.
Exactly. You have the peak summer concert festival season converging with the start of the NFL, the NBA, the NHL, and the MLB playoffs in the fall. They expect the massive profitability to skew heavily into the back half of the year.
So by reiterating the baseline guidance, they are intentionally managing expectations so they can comfortably beat them later.
The classic under-promise and over-deliver strategy.
But there is one specific macroeconomic event happening this summer that feels like it should blow out their Q2 and Q3 numbers, and they were bizarrely dismissive of it: the FIFA World Cup.
The management of the World Cup narrative was a masterclass in calculated communication.
It really was.
They acknowledged it as a Tier 1 global event that will provide a tailwind for the middle of the year. But the CFO went out of her way to explicitly state on the record, it is not comparable to Taylor Swift. She is a one of one.
I love that quote. The CFO of a multi-billion-dollar platform officially entering into the corporate record that the global FIFA World Cup, the largest sporting event on Earth, cannot mathematically compete with the economic distortion field of a Taylor Swift tour.
It sounds humorous, but it is a critical defensive maneuver against Wall Street analysts.
Oh, so?
Last year, the Taylor Swift tour fundamentally warped the local economies of host cities and completely distorted the financial modeling for ticketing platforms. It was an absolute anomaly in the data.
Right.
By explicitly warning analysts not to model the World Cup using the Taylor Swift coefficient, they are setting a realistic, achievable floor. They are preventing the buy side from building hyper-aggressive models that StubHub will inevitably fail to meet.
They are keeping the analysts on a tight leash. That's smart. But let's look at the balance sheet, because this is where the mechanics get incredibly exciting, especially for anyone still hung up on that $4.2 million GAAP net income figure. The free cash flow generation here is staggering.
Free cash flow is the ultimate truth teller in corporate finance. Over the trailing 12 months, StubHub generated $298 million in free cash flow.
Wow.
That represents an astonishing 116% conversion rate of their adjusted EBITDA into actual liquid cash.
Let's break that down mechanically.
Yeah.
How can a company convert 116% of its profit into cash? That implies they are generating liquidity out of thin air. The cash flow is physically higher than the underlying operational profit.
It is the absolute magic of working capital dynamics in a two-sided marketplace. To understand this, you have to look at the chronological timeline of a transaction. If you buy a ticket today for a concert that doesn't happen for another 3 months, StubHub charges your credit card immediately. They take possession of that cash today. However, to protect against fraud or event cancellations, they typically do not release the funds to the ticket seller until after the event actually occurs.
So for 90 days, StubHub is just sitting on the consumer's cash.
Exactly. It's a massive float.
It's the exact same mechanism Warren Buffett uses with insurance premiums. You collect the premium today, you pay the claim years from now, and in the meantime, you use that float as a zero-interest loan to fund your operations.
Precisely. They refer to this dynamic on the balance sheet as the net inflows of buyer receipts and seller payments. As long as the business is growing, meaning the volume of future tickets being purchased continues to outpace the volume of events currently taking place, that float continuously expands.
That's brilliant.
It is an incredible structural source of free funding. But even if you strip out that working capital benefit and back out the interest costs, their pure operational free cash flow is still $234 million.
Which is still huge.
That is a 91% conversion rate. The business is fundamentally a cash printing machine.
So if they are sitting on hundreds of millions of dollars in free cash flow and they aren't paying a dividend, where is all that capital being deployed?
They are aggressively and systematically de-risking the corporate structure. Immediately following the close of Q1, they took $100 million in raw cash and paid down a chunk of their U.S. term loan.
Cash on the barrelhead.
Yep. If you look at the trailing 12 months, they have retired over $1 billion in debt.
$1 billion in debt vaporized in a single year. That's a massive deleveraging event.
It really is. Their total outstanding debt is now down to $1.4 billion, and crucially, they have structured it so there are no maturities coming due until March of 2030.
So they have plenty of breathing room.
Exactly. We are operating in a macroeconomic environment where interest rates are significantly higher than the previous decade. Paying down floating rate debt in this environment is arguably the highest return allocation of capital available to them. It drastically slashes their ongoing interest expense.
Oh, wait. If we connect this back to my earlier concern about the GAAP net income, every time they retire a tranche of debt, that interest expense line drops, which mathematically forces the bottom line GAAP profit to rise, even if the core business metrics remain totally flat.
Now you're seeing it. The deleveraging is acting as a massive coiled spring for future net income.
That is wild. But what about the equity side of the equation? We talked earlier about the heavy reliance on stock-based compensation to retain engineering talent. If I buy 100 shares of StubHub today, how badly is my ownership percentage getting diluted by executives granting themselves RSUs?
Well, management addressed the dilution issue head-on, repeatedly utilizing the phrase disciplined dilution management.
Which sounds like corporate speak for we're diluting you, but we'll try not to be crazy about it.
Pretty much. At close of Q1, the basic common shares outstanding sat at roughly 374 million, but the fully diluted count, which factors in all the RSUs, options, and unvested equity, is hovering around 399 million shares. Moving forward through the rest of 2026, the CFO projected that dilution will be managed in the low to mid single digits.
Low to mid single digits translates to roughly 2 to 5% a year. That is a fairly standard runway for a newly public tech platform, but investors need to recognize it as a silent annual tax on their position. Your slice of the total pie is getting marginally smaller every year.
True.
But the math still works in your favor. If the overall pie is growing at 8 to 10% on the top line, and the profit margins are expanding by 400 basis points, the sheer velocity of the enterprise value growth easily absorbs a 3% dilution headwind. You still come out significantly ahead.
The math heavily supports the equity holder right now, no question. And there is one final massive catalyst buried in the balance sheet notes that provides a multi-year runway for cash generation.
What's that?
The CFO casually noted that the company possesses approximately $1.2 billion in NOLs.
Net operating losses. Okay, let's unpack this. How does a massive history of losing money translate into a fundamentally bullish indicator for an investor buying the stock today?
What's fascinating here is how corporate tax law allows past financial trauma to be weaponized as future capital.
Weaponized financial trauma, I love it.
Net operating losses function as a massive, legally sanctioned tax shield. During the pandemic, when live events went to zero, and during their heavily leveraged restructuring phases, StubHub incurred massive paper and operational losses.
That's silly.
Well, the IRS allows corporations to carry those historical losses forward to offset future taxable income.
So as this business scales and becomes wildly, aggressively profitable over the next 3 to 5 years, they essentially have a get-out-of-jail-free card with the IRS. They will not have to pay federal income taxes on the first $1.2 billion in profit they generate.
Exactly. It completely insulates their free cash flow from tax drag.
It is an immense competitive advantage. When you look at the complete architecture of this business, you see an engine meticulously tuned to trap and compound cash.
It's very impressive.
Which brings us to the final verdict. Taking the entire mosaic into account, the $2.2 billion in liquidity, the 85% gross margins, the shift to open API distribution, the massive float, the billion-dollar debt paydown, and the $1.2 billion tax shield, it's time to deliver on the talk ticker's mandate. What is the call on STUBB?
Based on a rigorous analysis of the Q1 source material, the stance is definitively and structurally bullish.
So what does this all mean for the listener? Let's make it actionable. If you are sitting on shares right now, or if you're looking at an entry point, what is the play?
For existing equity holders, this is a high conviction hold. The company has entered a highly lucrative maturation phase where it is utilizing its massive free cash flow to systematically deleverage.
Which builds value.
Every single time they use that cash to pay down $1 of debt, they are literally transferring enterprise value directly from the debt holders to you, the equity holder.
And for new buyers.
For potential buyers sitting on the sidelines, StubHub presents a highly attractive asset-light tech play. They do not own the stadiums, they do not manage the artists, they hold zero physical inventory, and they have empirically proven their structural resilience to inflation.
We are essentially watching a textbook flywheel effect execute in real time.
If we connect this to the bigger picture, the flywheel mechanics are undeniable. Their superior brand scale leads to unmatched marketing efficiency. They spend less to acquire users.
Right.
That efficiency drives the 400 basis point expansion in EBITDA margins. Those margins, combined with the working capital float, print massive free cash flow.
Which then pays down the debt.
Exactly. That cash flow pays down the expensive legacy debt. The debt reduction makes the equity intrinsically more valuable, while freeing up even more cash to reinvest in their AI and API infrastructure. They have successfully shed the growth at all costs startup mentality and transitioned into a cash-printing juggernaut.
So they aren't just surviving, they are dictating the terms of the secondary ticket market. But, and this is a massive but, we do not traffic in blind optimism here on Talk Tickers. We have to address the one existential risk factor that repeatedly surfaced during the analyst Q&A.
Regulatory intervention.
Exactly. The threat of regulatory intervention, specifically the specter of price caps.
Yeah, this is the perennial dark cloud hovering over the secondary ticketing market. Analysts aggressively question management about proposed anti-scalping legislation in the UK and the recent implementation of strict price caps in Ontario, Canada.
Now, to be absolutely clear, we're looking at this purely through the lens of structural economics, not the morality of ticketing. We need to evaluate management's defense against this regulatory threat, because if price caps become ubiquitous, the entire investment thesis shatters. How did the CEO navigate that regulatory pushback?
The CEO's defense relies on market mechanics and historical precedent. He argued that whenever a government jurisdiction attempts to artificially cap the resale price of a ticket, the policy inevitably backfires and punishes the consumer.
Interesting. How so?
Their internal data suggests that strict price caps reduce overall access to events, drive transactions off secure, guaranteed platforms like StubHub, and push the market into the shadows. The result is a four-fold increase in fraudulent tickets sold on platforms with no buyer protection.
Well, the economic logic tracks. If a buyer is willing to pay $1,000 for a front row seat, but the local government dictates you can only resell it for its face value of $200 on a regulated website, the seller isn't going to list it there.
No, of course not.
They will take it to Craigslist, Facebook Marketplace, or literally a dark alley where the transaction is invisible, unregulated, and highly susceptible to scams.
Exactly. Furthermore, the CEO dismantled the concept of a price cap by pointing out that the primary market has fundamentally changed. Enforcing a cap based on face value is becoming mathematically impossible because the primary ticketing venues now utilize dynamic pricing.
Right, there is no static face value anymore.
The venue's algorithm changes the initial price of the ticket in real time based on demand, exactly like Uber surge pricing. If the primary price is constantly fluctuating, establishing a legal baseline for a resale cap becomes an administrative nightmare.
So how are they classifying this risk?
Management ultimately categorizes these regulatory pushes as cyclical political noise, noting that recent legislative agendas in the UK entirely omitted the previously proposed price cap measures.
They are betting that economic reality will ultimately defeat political posturing. But as an investor, you have to keep that risk permanently on your radar. If a massive market like the United States somehow successfully legislates a hard cap on resale margins, that pristine 20% take rate we spent so much time analyzing will come under catastrophic pressure.
It's true.
It is the one structural vulnerability in an otherwise impenetrable armor.
It is an undeniable risk factor, but based on the current data and the failure of international test cases, it is not materially impacting their forward projections or their current cash flow generation.
Which brings us to the end of this deep dive. The mission today was to strip away the Wall Street noise, translate the corporate jargon, and deliver a hard, data-backed thesis on StubHub's Q1 performance that respects your time.
We examined a platform growing its top-line volume by 7%, but aggressively leveraging its pricing power to rocket revenue by 12% and expand its profit margins by 400 basis points.
We bypassed the shiny but depressed GAAP net income to find a core machine printing nearly $300 million in free cash flow, operating on a massive working capital float, protected by a $1.2 billion tax shield, and systematically vaporizing its debt load.
And we identified the structural pivot that will drive the next decade of growth, the transition away from high-friction business development contracts towards seamless automated API integrations that allow primary venues to utilize StubHub as an open distribution Expedia model.
That is the ultimate takeaway for your portfolio. In a highly volatile, unpredictable macroeconomic environment, identifying asset-light platforms that generate real, liquid-free cash flow, not just paper accounting profits, is the key to capital preservation and growth. StubHub is a business engineered to extract a toll on human passion, and human passion has proven to be incredibly inflation-resistant.
It certainly has.
But before we wrap, I want to leave you with one final structural question to think about, a concept that builds on everything we unpacked today. StubHub is betting its entire technological future on this concept of open distribution. They are building the AI and API infrastructure to convince massive sports teams, global artists, and mega venues to abandon their exclusive monopolistic contracts with primary ticketing giants.
It's a huge bet.
They want tickets sold non-exclusively across multiple platforms simultaneously, just like Delta puts its flights on Expedia, Kayak, and its own homepage. If StubHub actually pulls this off, if they successfully break down the walls of exclusive ticketing and turn a live event ticket into a digital commodity traded freely across the open internet, does the traditional monopolistic primary ticketing model collapse?
That is the billion-dollar question.
We have spent the last 30 years with one giant entity dictating exactly how and where primary tickets are distributed. If the API revolution makes open distribution the new standard, who ultimately wins that war? Is it the massive aggregator platform that commands the most consumer eyeballs? Is it the artist who finally regains control over their own yield management? Or is it finally the fan who gets true transparency and choice?
It introduces an entirely new layer to those diagnostic muddy waters. We aren't just looking at the maturation of a single company anymore. We are watching the structural foundation of a multi-billion-dollar industry fracture and realign.
We absolutely are. The old models are breaking in real time. Keep asking the hard questions, keep digging past the headline numbers, and we will see you on the next deep dive.